The other big factor in all of this, in global liquidity, and maybe the big daddy of all, is the dollar itself.
Yeah.
Now, it's been clear that Besant wants a weaker dollar, the US wants a weaker dollar, the world needs a weaker dollar. Does that continue weaker? Because that's a very important factor in all of this, because the dollar is the funding currency of the world.
Well, I think the answer, like for the Raoul, is yes and no. It depends against what. So this is looking at the trade weighted dollar, and this is the way I tend to think about the dollar anyway. I like the real trade weighted index that the BIS does, and this is really showing what I think are the sort of the underlying currents in the dollar. So what you had the long downtrend in the dollar broken around the time of the GFC, and then you've seen this upward channel. At the moment, we're having a cyclical correction in that, in my reckoning. There's no evidence that the dollar this is the paper dollar, is really being undermined. And ironically, if you look at the following chart, which is looking at net inflows into the dollar, they still seem to be very strong. There's no evidence that we can find in the data that money is leaving the dollar. And this to be 100% accurate here or complete, this is not looking at the US data, the TIC data, which is notably rogue and not that accurate. This is looking at what all other countries are saying they're actually putting into the dollar. So presumably it may have biases, but it's a more accurate read as to what's going on. And it looks as if money is still flowing. You can see what happened after the GFC 2010 and after the Eurozone banking crises. A lot of money flowed into the dollar, and that's really been a mainstay of the US market. It's still there. So I think that if you look at the paper dollar, I think that still looks reasonably robust. I accept the point 100% that I think the administration wants to get it weaker, but I think it's a bit of a challenge for them to get it weaker given these dynamics. But I do think they want to try and talk it down, and that's the evidence that one gets.
Yeah, and I think on a cyclical basis, I don't think we're at a, the full Plaza Accord nuke the dollar basis. We just don't have that much stress in the system. And listen, I think it's over 50% of world debt is in dollars. Mm-hmm. A weaker dollar allows people to refinance their debts. So it tends to be cyclically weak to allow this mechanism to happen, allows everybody to stimulate, do what they need to do. That ends up being the debasement of currency. Even though you get dollar inflows, people get confused by this. It's like, no, the dollar's still fundamentally strong and is gaining as the world's reserve currency, but its purchasing power via debasement is actually decreasing.
Yeah, absolutely. And I think, what could it weaken or strengthen against? Well, if you look at, I think the yen is, my view is I think the yen is deliberately being held down. I think that the Chinese yuan has to weaken against the US dollar in some form.
Yeah.
And I think that if you look at the European units, I think the whole fiscal backdrop is so ugly that I can't see why the euro should strengthen particularly against the dollar anyway. So, there may be a case for some of the emerging market currencies picking up, or the Aussie dollar cyclically. I don't know, but they're tiny in the context of things. On the other hand, if you're debasing, the main standard of value in the world economy, then you're going to have real assets like gold, silver, precious metals going up, and you're going to have cryptocurrencies going up at the same time. So these are the hedges against this long-term monetary debasement. And I know you keep saying, there's a trend here and there's a cycle. The trend looks, compelling. The cycle, we may be coming to the end of it, but, cycles go up and down.
The other thing, so just zooming in now, is we use our financial conditions index as a lead on total global liquidity. And it has been sideways for a while, but it looks like it's about to expand again because it's the dollar, interest rates, and all of those seem to be moving in the favor of that, which then gives us a longer lead on the cycle. So I'm trying to get your thinking on, okay, what does the next 3 to 6 months look like on a forward basis from what you can see from liquidity?
Okay, I mean, my view is, I'm not bearish on liquidity over that time frame. No. I think that there are a number of questions that people will raise, and I think one of those, and I'm going to show you another chart, hopefully if this one works, is is what's happening to the Fed balance sheet. So that's number one. And this is looking at a concept that, I call Fed liquidity, which is the thing that I came up with, when I wrote that book, Capital Wars, which is looking at, the various components that the Fed uses to get liquidity into the system. Now, that's clearly an important element. It's not the whole story, but it's an important element. And what this is basically showing is that if you look at the projection period, on paper, the growth of Fed liquidity falls and goes negative. And the reason for that is if you come back to the underlying ingredient, which is US bank reserves, this chart is showing our projections through year end of US bank reserves based on...
Yeah, everyone's getting really caught up on this because they're like, the reverse repo is empty, and therefore, if you rebuild a TGA, you've got a massive liquidity shock.
Yeah. So, I mean, the question is, number one, will they rebuild the TGA? Well, okay, if you look at the quarterly refunding announcement, it says they're going to go back to 850. Well, I would be staggered if they get there, because to take that amount of money out of money markets would cause the repo spread to spike. And I don't think they want to do that. There's every indication they're trying to manage the repo spread. So I don't buy the fact they're going to put it up. Even if they do put it up, you can find other ways of injecting liquidity, as we said, through Treasury QE or getting the banks to buy debt. So I think there are other ways around it. But, what that chart is trying to illustrate is that the dotted line, the red dotted line, is my estimate of what adequate reserves are, minimum reserves in the system. And it looks as if there was that step change back last August when you got the change in the stress test rules. But basically, what's happened to bank reserves through this year is they've very closely hugged to that dotted line. And I think that's deliberate because, as we know, the Federal Reserve controls bank reserves in aggregate completely. And I think that's what they're targeting, amongst other things. So to see that drop off, which is the TGA rebuild prospectively, I just don't buy. I don't think it's going to happen. So I think that number one is you've got still pretty decent Fed liquidity, and everything that I hear Scott Bessent say and what I see the Fed doing is they want to manage that liquidity. They don't want to pull the rug from the markets. Why should they? Number one. I think if you look at offshore markets, or in other words, international markets, I think that Europe continues in the groove it's been doing, which means adding more liquidity. They're going to have to do that anyway. And I think all the moves are towards more ease in Europe. Japan, I think, follows because they want the yen to remain soft. And China is embarking on a major monetary expansion. So as far as I can see, the liquidity background still looks to be pretty benign over that time frame.
Yeah, I mean, we look at both the Fed net liquidity of this, and this is what a lot of people are talking about is, oh my God, this is going to be a liquidity shock. But when you look at total liquidity, because it takes into account what's happening in the banking sector, it's a different chart.
Yeah.
And it seems to be that it's the total liquidity dominance now, and this has become more of a steady as she goes factor. Same with the balance sheet. So they've moved away, even though the balance sheet's a component of this, but they kind of move away from these things over time. And it now seems to be it's the banks. And, there's other mechanisms. They can use the pension system and the insurance sector as well at various points, because they're all the big buyers of bonds.
Yeah. Yeah, I think this is, I think Scott Bessent, as we know, is a clever guy, and I think he's thought these things through, and he is conscious of the fact that liquidity is critical to markets.
Yeah, exactly. It helps having a hedge fund manager as the Treasury Secretary, because we all speak the same language. So we kind of know what he's up to. So where is your, to go back to where we started, your best guesstimate right now of when liquidity peaks? Is it Q1? A bit longer? I'm in the camp of Q2, but obviously it's probabilistic and it can change, but it's not this year. And
no, it's not this year.
That's a big important factor for markets.
Yeah, it's. In my view, it's at least 6 months away. I mean, the estimates we came up with, we use leading indicators. Those leading indicators are based on factors like what the business cycle is doing, what's happening to things like oil prices, what's happening to volatility in the bond markets. A number of things. But that actually comes up with the latest figure that I saw was March of next year. So it's pretty much close to where you're saying.
So you obviously like this video enough that you've got to the end. That's quite a big task. But listen, do me a favor, hit the like and subscribe button, and also check out what video's next, because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research, everything there to help you in your journey, just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.